If your salary went up, but life still feels more expensive, you are not imagining it. This is one of the most confusing feelings in personal finance. You may be earning more than before, but your life may not feel easier. The number in your bank account is called nominal money. It is the amount you see on your payslip or in your balance. Purchasing power is different. It means what that money can actually buy in the real world. Imagine your monthly salary as a bucket. At the start of the month, money flows into it. Then small leaks begin. Rent, food, transport, fuel, school fees, insurance, subscriptions, loan payments, and utility bills all take their part. When prices rise faster than income, the leaks become larger. You may pour more money into the bucket, but the bucket empties faster too. Inflation simply means that the overall price of many goods and services rises over time. It does not mean every single item becomes expensive at the same speed. One item can become cheaper while the total basket still becomes more expensive. That basket is important. Your real cost of living is not a headline number on the news. It is your actual home basket. For example, a 5% salary raise sounds good. But if your real household costs rise by 8%, your lifestyle may still feel 3% weaker. That is nominal versus real money. Nominal money is the number. Real money is the buying power behind the number. This is why a higher salary does not automatically mean a stronger financial life. If $100 bought 10 bags of groceries before, but now buys only 8, the number stayed the same, but its power dropped. So when people say they feel squeezed even after a raise, the feeling can be real. It is not always poor discipline. Sometimes the financial environment changed faster than the person's income. The first step is simple. Track your personal basket, not only your salary. Write down the costs that actually affect your home: housing, food, transport, school, debt, insurance, medical costs, and family needs. Then separate fixed pressure from flexible spending. Fixed pressure is the spending you cannot easily remove this month. Flexible spending is the area where small changes may help, but it should be done calmly, not with panic. The second step is to build breathing room. Even a small emergency buffer can reduce stress when prices jump. A buffer does not solve inflation, but it gives you time. Time helps you avoid rushed decisions. The third step is to understand debt pressure. Debt payments can turn a small price increase into a much heavier monthly burden. When debt is high, more of the salary is already committed before the month begins, so the bucket has less room. The fourth step is education. Learn how inflation, savings, debt, interest, and long-term planning work before making major decisions. Do not hear the word inflation and immediately rush into risky investments. Awareness should make you calmer, not reckless. Cash has time value. Money sitting idle can lose purchasing power when prices keep moving up, but risk also exists. Chasing returns without understanding them can create bigger losses than inflation itself. A better measure is breathing room. Are bills becoming easier to handle? Is debt reducing? Is your emergency fund growing? Are choices becoming easier? Those signs often matter more than simply saying, "My salary increased." Financial progress is not always dramatic. Sometimes it is small control returning to your month. The main lesson is this: a bigger salary helps, but buying power decides how that salary feels. Protect the bucket. Understand the leaks. Learn the rules. Make slower, safer decisions. Money in plain lines. Simple money lessons, one clear idea at a time. This video is for educational purposes only and is not financial advice. We do not provide investment recommendations, trading signals, or guaranteed returns. Always do your own research and consult a qualified financial advisor before making financial decisions.